Hello, my name is Elliott Gu. I'm editor of Personal Finance, and today I want to talk a little bit about the broader market as well as the economy. Obviously, in May, in the employment report for May, we got the number that 54,000 jobs were created total, and if we back out the loss of about 30,000 government jobs, both at the federal, state, and local level, it was about an 83,000 job creation for the month of May. Now that was way below expectations. Market expectations were for over 100,000 jobs to be created. And those expectations had been tempered by the ADP employment report, which was released earlier that same week, which came in under expectations as well. This is really just the latest in a series of poor economics reports that we got throughout the month of May and through June. And basically what we've seen is that ever since mid to late April, most of the economic data has been coming in a lot softer than economists had been forecasting, whether it's employment, housing, etc. And really there has been signs of a summer soft patch, similar to what we saw back in 2010. The first signs we saw of that is one of my favorite indicators, which is the Purchasing Managers Index, which basically tells you it's based on a survey of purchasing managers in both the manufacturing and in the non-manufacturing sectors of the economy. They simply ask them, do you think things are getting better, about the same, or getting worse? They tabulate these numbers and they come out with an index. Now, when those numbers are above 50, that indicates, generally speaking, that the economy is still expanding. Numbers at 60 or above are actually considered very high and consistent with very strong economic growth. Numbers under 50, or really back around the 46, 47 area, are consistent with significant slowdown in growth or potentially a recession. Those are really the danger areas. What we've really seen this year is that numbers went from very high levels early in the year, really slowed down in the spring and early summer, and then down into the low to mid 50s from around 60. Now that's consistent though with a slowdown in growth, not a recession. On the housing front, much has been made of the so-called double dip in housing, and we're certainly seeing that. Housing starts are near record lows. Existing home sales have been very weak, even during the seasonally normally very strong spring selling season. But the reality is that no one expected a whole lot of strength out of the housing market. House prices are troubled by excess inventories out there and what's known as shadow inventories. Now what that is this simply a large number of homes that are either already in foreclosure or are owned by people who haven't made mortgage payments in a long period of time and are likely to enter the foreclosure process at some point in the future. Now, as a steady stream of foreclosures hits the market, those homes compete with other existing homes that aren't in foreclosure, as well as new homes that are being built. Now, obviously, people demand a significant reduction in price of about a third overall for homes that are in foreclosure. So people aren't going to pay top dollar for homes that are in foreclosure. And with those homes competing with new homes and with other existing homes outside foreclosure, you're not going to see a whole lot of upside in home prices. And I expect that to be the case, and I've been saying that's going to be the case for a long time now. We're probably not going to see any sort of a real recovery in the U.S. housing market in terms of major upside in prices for the next 3 to 5 years. But the truth is that this is nothing new. Nobody's really been looking for a recovery from that. And the fact is that with house prices sort of bouncing along the bottom, construction spending sort of bouncing along the bottom, it's not really going to have much of an additional downside effect to GDP. Most of the worst is behind us. But we're just not going to see a whole lot of upside from that sector. The other thing to keep in mind is a large number of temporary headwinds that the economy's been facing in the first half of 2011 and into the second half. One of those is the Sendai earthquake back in March. What happened out in the wake of that is a large number of factories in Japan were forced to close down. For example, a lot of companies that make automobile parts that export those to the United States that are used in both Toyotas and Hondas and other Japanese manufactured cars, but also in cars manufactured in the U.S. like Ford and GM also get parts from Japanese manufacturers and had those part shipments delayed. What we've seen is that inventories of cars at dealers in the United States are very lean right now. And as a result, they're not really offering much of a price discount off the sticker price, and that's slowed auto sales. So some of the weakness we're seeing in numbers like automobile sales, as well as the manufacturing sector, isn't really due to a slowdown in the economy so much as it is to part shortages in Japan, which caused manufacturers to shut down certain plants, temporarily close plants, or work lower amounts of hours per week. Also caused, obviously, a drop in automobile sales, which shows up in the consumer spending figures. Another factor, of course, was the spike in commodity prices we saw early in 2011. Food and energy prices really spiked to the highest levels we've seen since 2008, in some cases to record levels. But we've seen a little bit of a commodity slowdown since April or May. Oil prices are back off the boil, so to speak. In the U.S., oil prices have dipped back down under $100 a barrel, and Brent crude oil prices, sort of the international benchmark, are sort of well off their highs of almost $130 a barrel earlier this year. So that's a factor that did affect consumer spending, certainly in the spring, and that started to sort of come off as a headwind. So my point is very simple. Yes, the U.S. economy is experiencing a soft patch, a little bit of a slowdown in the late spring and early summer. But much like 2010, this is nothing like a recession. This is a slowdown from pretty robust growth at the end of 2010, and it's also been severely impacted by temporary factors such as the Japanese earthquake and things such as the spike in commodity prices we saw in early 2011. I expect that later this year we're going to see stock prices recover and probably hit new recovery highs by year end. And it's a great time right now in this temporary soft patch when we're seeing a pullback in stocks to go out and pick up stocks in my favorite industry groups, sectors like energy and technology. These companies are pulling back just and simply with the broader market. Long-term fundamentals still look strong, and as the U.S. economy recovers in the second half, as I expect, these stocks, just like they did a year ago, are going to move to new highs. So I encourage you all to check out Personal Finance. We have an excellent long-term track record of navigating through environments like this. We've beaten the S&P in the 3, 5, and 10-year periods. So click the link at the bottom of your screen and check out Personal Finance today. Thank you very much.